This is Money Talks, your fave podcast about money. Week 9 on picking stocks. Today we'll be looking at some numbers. If you don't like numbers or find it hard to follow, all this info is available on my blog in readable format. Link is right below in the description. So let's look up a stock using Google Finance together. So go on Google and type in McDonald's stock. Yes, McDonald's like the restaurant chain. Then hit enter. A chart should pop up with the title Market Summary. The letters NYSE at the top means New York Stock Exchange. MCD that you see there is the stock ticker. It is one of one or two letters or three usually used to easily search up stocks. The big number below that you see is the stock price in dollars, in this case USD, US dollars. Now a rookie mistake. The price listed there actually doesn't mean much. What matters is if you scroll down and look, you'll see the market cap or MKT for short. This is what the stock market values the company at, or market capitalization. For example, a stock with a price of $10 with 1 million outstanding shares on the stock market has a market value of $10 million. Basically $10 times 1 million shares, giving us $10 million market value. Another company with a stock price of $100, but with 100,000 shares outstanding in the market, also has a market value of $10 million, because $100 multiplied by 100,000 shares outstanding also gives us $10 million. Therefore, both the $10 and $100 stock has the exact same market value. The $100 stock isn't necessarily better or more expensive than the $10 one. And as the stock prices moves up and down real time during trading days, so does the market cap. Or once in a while the company might buy back shares or issue more, hence affecting the market value as well. Sounds confusing? Make sure to read my blog post over this, it will become more clear. Well then, how do we tell if a stock is cheap or expensive? Look below the price chart and you will see the letters P-E ratio. This is short for price earnings ratio. Just as it implies, it calculates the price of the stock divided by the earnings per share or EPS of the company. It is the ratio of how much the stock is trading at versus how much money profits the company is reporting. Expectations around future earnings, another word for profit, of the company has a huge impact on the stock price. A lower PE ratio tells us that a stock is cheaper versus one that has a higher PE. But you want to compare apples to apples and oranges to oranges, so PE ratios are usually most helpful when comparing competitors in the same business or industry. On the same chart, looking at McDonald's, you will notice the words open, high, and low. Those are simply the daily prices today or the last trading day when the markets were open. Open is what price was of the stock when the markets opened, and the high/low are the daily peak and bottom of the stock price. Similarly, there are the 52-week highs and lows to give you an idea of what the stock has been doing over a longer period. The same info, as you may have figured out, can be derived by looking at the price history chart above. A stock where the price has crazy ups and downs is a volatile stock, and probably not for you if you have a low risk tolerance. You might want to look at stocks where there is less price volatility. Also remember, past price trends do not indicate future price trends. Things can change quickly, and the position of a company can get worse or better, or the market sentiment about the company can change. Take a look at the div yield or dividend yield. At this time, the time I made this, McDonald's had a dividend yield of about 2.5%. This is the percentage you get paid by the company for holding their stock annually, even if you don't sell your stock for a gain. It is a share of the company's profit consistently paid out to investors. Consistent as long as the company decides not to scrap or maybe lower the dividend, but usually they do increase it over time. It is a share of the company's profit, consistently paid out to investors, sometimes in bits and pieces, monthly or quarterly, or all annually at once, depends on the company and dividend policies. So, imagine I had $1,000 invested in McDonald's stock with a current dividend yield of 2.5%, I would get $25 every year in dividends. $10,000 of the stock would earn me $250 annually, so not bad at all. So there you have it. Now you can read a Google Finance profile quite easily and know what all those numbers mean. You're already ahead of a lot of people. So make sure to come back next week as we delve deeper into picking stocks quantitatively, part 2.